and how to reboot Britain's capital markets. A strategic approach focused on improving competitiveness, innovation, and resilience is necessary to reboot Britain's capital markets, maintaining its status as a major global financial center in the face of shifting geopolitical and economic environments will require striking a balance between risk and opportunity. How to revitalize the capital market. Today, we will discuss few strategies for reviving the British capital market. Reducing bureaucratic obstacles and combining redundant regulations are two aspects of simplifying regulations. This can be accomplished by identifying obsolete or superfluous regulations through thorough reviews and discussions with market participants. A wider variety of businesses are encouraged to consider public listings when listing regulations are changed to account for different company structures and industry sectors. Requirements that are customized according to industry, company size, and stage of growth can draw in both cutting-edge startups and major enterprises. London's appeal as a global financial hub is increased by ensuring regulatory alignment with international standards, such as those established by the Financial Stability Board and International Organization of Securities Commissions. Regulatory harmonization facilitates international trade and increases investor trust and uniformity. The stabilization and expansion of listed companies are in line with investor incentives when capital gains tax rates are modified to encourage long-term investment. Incentives such as lower rates for investments held for longer periods of time can promote patience and lessen market volatility in the near term. Venture capital flows are stimulated by the introduction of targeted tax incentives for startup investments, such as tax credits or relief programs for early-stage investors. By reducing the higher risk involved in funding creative, early-stage businesses, these incentives promote creativity and entrepreneurship. Modernizing data centers, communication networks, and trading floors are all part of the upgrading of the physical trading infrastructure. Modern infrastructure facilitates increased transaction volumes, quicker execution times, and enhanced resilience in the face of market volatility. Improving digital infrastructure entails modernizing electronic trading platforms and increasing high-speed internet connectivity. In the digital age, seamless digital connectivity ensures that London stays competitive by enabling electronic trading, remote access for global investors, and the transfer of market information in real time. The creation of regulatory sandboxes enables fintech companies to test novel goods and services under supervision. Regulatory sandboxes offer a secure environment for testing ideas while preserving financial stability and consumer protection. Encouraging partnerships between fintech startups and established financial institutions facilitates the adoption of new technologies and the spread of innovative ideas. Collaborations can result in the development of new financial products, increase operational effectiveness, and better customer experiences, putting London at the forefront of the world's fintech innovation. Putting in place thorough financial literacy initiatives teaches people about risk management, investing, and financial planning. Improved financial literacy encourages long-term saving practices, gives investors more power to make wise decisions, and boosts market participation overall. Improving disclosure laws, market monitoring tools, and corporate governance norms are some ways to fortify transparency initiatives. Transparent reporting improves market integrity and efficiency, decreases information asymmetry, and builds investor trust. Encouraging capital allocation towards environmentally friendly initiatives can be achieved by providing financial incentives, such as tax breaks or subsidies, for investments made in sustainable businesses and green initiatives. London is positioned as a leading hub for sustainable finance thanks to green finance incentives that draw institutional investors dedicated to ESG environmental, social, and governance standards. ESG considerations improve risk management procedures and encourage ethical investing when they are incorporated into investment decision-making processes. Standardized reporting frameworks and mandatory ESG disclosures promote accountability and transparency, which in turn helps to fuel the expansion of green financial services and products. Cross-border investment flows and market integration are encouraged by strengthening international alliances through bilateral agreements and regulatory cooperation. Complying with international regulatory standards lowers the cost of compliance for foreign investors and makes London a more attractive destination for global financial centers. Regulatory arbitrage is reduced and market efficiency is increased by working toward regulatory harmonization with important financial centers. Harmonized laws make cross-border transactions easier, increase regulatory clarity, and draw institutional investors and multinational companies to London's capital markets. Reducing regulatory burdens, offering funding support mechanisms, and customizing listing requirements are all necessary to help SMEs gain easier access to capital markets. Specialized listing segments or secondary markets are examples of dedicated SME platforms that address the particular requirements of smaller companies looking for growth capital. SMEs are assisted in navigating capital raising procedures, investor relations, and regulatory compliance by providing specialized advisory services, mentorship programs, and networking opportunities. Professional advice enables SMEs to successfully use capital markets for growth, employment creation, and innovation. Using smart contracts and blockchain technology for security settlement improves operational efficiency, transaction security, and transparency. Artificial intelligence drives innovation and boosts market competitiveness by improving risk assessment models, customer service, and market surveillance capabilities. Real-time market insights, predictive analytics, and customized investment strategies are made possible by utilizing big data analytics. Making decisions based on data increases market transparency, facilitates accurate investment choices, and boosts overall market liquidity and efficiency. Continuous evaluation of market dynamics, such as investor sentiment, liquidity conditions, and regulatory compliance, is made possible by putting in place strong monitoring systems. Timely interventions and regulatory adjustments are facilitated by real-time data analytics and market surveillance tools. Regulatory agility and responsiveness are maintained by regularly assessing and modifying regulatory frameworks in response to changing economic trends, technological breakthroughs, and developments in international markets. Regulatory approaches that are flexible foster innovation, improve market resilience, and uphold London's standing as a vibrant and competitive global financial hub. Offering incentives to attract private investment, such as tax breaks, subsidies, or guarantees, are one way to encourage the private sector's involvement in infrastructure projects. This entails expediting regulatory clearances and offering assurance regarding project schedules and yields. Clearly defining roles, responsibilities, and risk-sharing mechanisms between public and private partners is essential to the establishment of a clear regulatory framework for PPPs. To reduce the risks associated with project execution, this involves clear procurement procedures, uniform contract agreements, and dispute resolution procedures. Effective risk-sharing mechanisms must be implemented, and this requires PPP contracts to be structured so that risks are appropriately shared between the public and private sectors. In order to safeguard investors against the operational and financial risks connected with infrastructure projects, this includes revenue guarantees, performance-based compensation, and insurance coverage. Reducing regulatory obstacles and entry requirements for investors from emerging markets is a key component of facilitating market access. To encourage cross-border investment flows, this can involve setting up bilateral agreements, mutual recognition agreements, or regulatory sandboxes. Offering a variety of financial products and investment vehicles that are suited to the risk tolerance and investment preferences of foreign investors is one way to encourage investment diversification across emerging markets. To draw on a variety of capital inflows, this involves marketing emerging market bonds, global depository receipts, and exchange-traded funds. Harmonizing regulatory practices and standards with important emerging market jurisdictions is a necessary step in providing regulatory support. To improve market integration and enable easier cross-border transactions, this entails coordinating disclosure laws, investor safeguards, and market conduct guidelines. Examining the resilience of market infrastructure, financial institutions, and systemic risks in the event of a downturn in the economy is a crucial aspect of conducting thorough stress tests. This involves sensitivity testing, scenario analysis, and capital adequacy evaluations to pinpoint weaknesses and improve risk management procedures. Regulatory agencies, financial institutions, and market participants must establish coordination mechanisms, communication protocols, and crisis management frameworks in order to develop strong backup plans. To practice crisis management techniques and guarantee preparedness in the event of market disruptions, this involves holding tabletop discussions and simulation exercises. Improving stakeholder coordination and crisis communication transparency are key components of strengthening communication channels. This entails prompt information distribution, public declarations, and cooperation with foreign counterparts in order to reduce the potential for contagion effects and quickly rebuild market confidence. Britain can successfully revive its capital markets and create a strong, creative, and internationally competitive financial ecosystem by putting these broad strategies into practice. These programs are intended to draw on a wide range of investors, encourage steady economic expansion, and strengthen its standing as a preeminent global financial center. Please click the like button and subscribe to our channel to see more videos if you enjoyed this one.